Hello, this is Craig Larson with Larson Financial Advisors for the Market Minute on October 1st, 2015. Well, since my last video back on August 26th, we've had a little bit of a bounce back in the market after that death plunge on August 24th, but a lot of sideways consolidation and volatility since then. So you might remember that August 24th, it was the largest intraday drop in stock market history. Prices just got vaporized within an hour of the open. The day ended up minus 4% for the day, and so a lot of that loss was recovered, but still kind of a bizarre event. And so now the market is continuing to sort of churn sideways, trying to figure out what direction it wants to go. Now, we've had a few shifts in our broad rankings and asset classes. So U.S. stocks, however, is still in first place versus the other 5 major asset classes. Bonds are in second place and have continued to pick up some points. Money market remains in third place, and foreign currencies are in fourth. Now, international stocks are now in fifth place, and in 2015 have fallen all the way from second place down to fifth place, and has been one of the worst asset classes to be in 2015. And commodities are still in sixth out of sixth place. Now, there's been an interesting development on the S&P 500 that I'm going to mention, and I follow something called a weekly price momentum oscillator. It's a math formula designed to determine long-term market momentum, and that indicator for just the 4th time in the last 20 years has turned negative now. And so a little history with that indicator. Back on October 2000, that weekly momentum turned negative. And we know what happened after that. It was a very rough market for 2 years. January 2008, that indicator went negative before most of the nastiness of the '08 collapse. And then August of 2011, which was really more of a blip on the radar. The momentum went negative. There was a lot of volatility for 3 months. And then the market got going again in December 2011 and into January 2012, continued its bull market run. So where will this take us now? Well, we don't know, unfortunately, but the risk indicators would continue to point to some pretty iffy markets right now, so I would continue to be cautious about that. By the way, if you want to see the S&P 500 chart with those momentum shifts, send me an email. I'll get one out to you. And right now, however, the market's pretty oversold, which means if you think of like a rubber band that kind of it gets too stretched out, and so we'll probably have a little bit of a market bounce coming up, no guarantee. But that bounce will continue to tell us if we're now in the beginning stages of a longer term negative market. So if this bounce, when it comes, is tepid, then hold on to your hat. We probably have a longer term negative market coming. If the market can get going enough to turn that weekly momentum indicator positive, maybe we end up like a 2011. So stay tuned. Things continue to be very interesting. Thank you for tuning in, and have a great day.